Welcome to today's deep dive investment analysis on Acutaas Chemicals Ltd, a fascinating story from India's specialty chemical space. If you're new here, we break down Indian stocks with a full technical and fundamental lens. Today's company is especially interesting. It was formerly known as AMI Organics, rebranded in May 2025, and has since become one of the most talked about mid-cap chemical plays on the NSE. The stock has returned over 119% in the past year, and today we're going to understand why and whether there's still opportunity ahead. Let's dive right in. Let's start with the basics. Acutaas Chemicals was originally founded back in 2004 as AMI Organics, a name many of you may already know. In May 2025, the company rebranded to Acutaas Chemicals to reflect its expanded scope beyond just pharma. The company is headquartered in Surat, Gujarat, right in the heart of India's chemical belt, and is listed on both the NSE and BSE. What makes this company interesting is its diversification. It's not just a pharma intermediates play anymore. It has 5 distinct business segments: pharmaceutical intermediates for drugs like antiretrovirals, anti-cancer and antidepressant compounds, specialty chemicals for agrochemicals and electronics, battery chemicals for the booming EV sector, semiconductor photoresist chemicals, that's a newer high-margin area, and commodity chemicals for cosmetics and fine chemicals. This diversification into batteries and semiconductors is what's really got the market excited. Let's dig into the financials. Now let's look at what's really been driving this stock, the numbers. From financial year 2021 to 2025, Acutaas grew its revenue at a 5-year compounded annual growth rate of 34%. That's exceptional, especially in a sector that saw major headwinds from China's resurgence in the chemical supply chain. In financial year 2025, revenue hit 1,215 crore rupees, and for financial year 2026, based on the 3 quarters reported, they're tracking toward around 1,380 crore rupees, a continuation of that trajectory. Now, look at the profit line. This is where it gets really interesting. Net profit has compounded at 42% per year for 5 years. From just 20 crore rupees in financial year 2021 to 285 crore in financial year 2025. That's a 14 times jump in absolute profits. Quarter 2 of financial year 2026 saw net profit surge 91% year on year. Quarter 3 saw profits jump another 134% year on year. The forward 3-year projected compounded annual growth rate sits at approximately 29% for revenue. If management delivers on its stated 25% growth guidance and margins continue improving, which we'll cover next, this is a genuine compounding machine. Margin expansion is the story within the story here, and this is what really justifies the premium valuation. The gross margin stands at a very healthy 52.7%. For context, most Indian specialty chemical companies operate at 35 to 45% gross margins. Acutaas is at the higher end, suggesting strong pricing power and a favorable product mix. The operating margin has expanded dramatically from around 20% a year ago to now around 28 to 31%. And the net profit margin has gone from just 5% to 23.6%. That's a near 5 times improvement in profitability ratio in just 12 months. Look at the EBITDA margin trend. Each quarter, we can see it expanding steadily from 19.75% in quarter 2 of financial year 2025 to 31.55% in quarter 2 of financial year 2026. That's a 1,180 basis point expansion, an absolutely phenomenal operational improvement driven by capacity utilization, process efficiency, and lower finance costs. This tells us the Ankleshwar expansion project, the new distributed control system technology plant with 442 kiloliters of capacity, is now generating significant operating leverage. Fixed costs are being spread over a much higher revenue base. The balance sheet here is genuinely impressive. Acutaas is essentially debt-free. It has 2,410 crore rupees in cash against just 83 crore in debt. That's a net cash position of 2,320 crore rupees. This gives management enormous flexibility for acquisitions, further capital expenditure, or additional buybacks. The company has already bought back 8.75% of its shares in the last year. That's shareholder friendly capital allocation, which boosts earnings per share mechanically. Now, valuation. Let's be honest, this is the risk factor for this stock. The trailing price to earnings of 69 times is elevated. The price to sales ratio of 16 times is high even by Indian pharma standards. The stock trades at 13.7 times book value. But, and this is a big but, when you look at the PEG ratio of 1.25, it's actually reasonable given the 42% earnings compounded annual growth rate. Growth investors typically accept PEG ratios up to 1.5 for high quality compounders. The forward price to earnings of 53.84 times gives us some comfort. The market is pricing in growth, and if that growth delivers, the multiple will come down naturally over the next 12 to 18 months. The analyst median target is 3,157 rupees, roughly 56% above current levels. And the stock holds a Mojo score of 82 out of 100, strong buy. Now let's put on our technician's hat and look at the charts. The stock is currently trading around 2,322 rupees. The most important signal here, it's sitting above its 20-day, 50-day, 100-day, and 200-day moving averages. This is a textbook bullishly structured chart. Every key long-term support line is intact and sloping upwards. The only concern is the very short term, the 5-day moving average. The stock dipped below it after a sharp 16% correction from its 52-week high of 2,634 rupees. That recent correction is actually healthy. The stock hit a new 52-week high on April 1st, but reversed sharply the same day, a clear profit booking event. That kind of reversal after a strong multi-day run is normal and doesn't negate the broader uptrend. On momentum indicators, the weekly MACD is bullish. Bollinger Bands are expanding to the upside on the weekly chart. That's a positive. The monthly RSI is slightly cautious, suggesting we don't want to chase right now. Investing.com's aggregated signal across all time frames is strong buy. That's all time frames from 5-minute to monthly. The stock has delivered 388% returns over 3 years versus the Sensex's 21%. Year to date, it's up 27% while the Sensex is down 16%. That's massive alpha generation. The beta of 1.24 against the Nifty Midcap 150 tells us this is a volatile name. Expect swings of 10 to 15% in both directions when markets move. This is where the genuine bull case lies. Acutaas has multiple growth drivers stacked on top of each other. First, the Ankleshwar plant. This was a 1,900 crore rupee capital expenditure project that came fully online in financial year 2025. It uses advanced distributed control system technology, giving them process efficiency advantages. We are now seeing the benefits in margins. This is the engine behind the 1,100 basis point EBITDA expansion. Second, battery chemicals. They've created a dedicated subsidiary specifically for lithium cell electrolyte additives. As India pushes electric vehicle adoption aggressively, the upstream chemical supply chain needs to develop domestically. Acutaas is positioning early. Third, and this is the most exciting long term opportunity, semiconductor chemicals, photoresist chemicals for chip fabrication. This is an incredibly high barrier, high intellectual property, high margin business. Very few companies globally make these. Acutaas entering this segment puts them in a completely different valuation conversation long term. Fourth, contract development and manufacturing, or CDMO. As global pharma companies reduce China dependency, Indian CDMO players are the primary beneficiaries. Acutaas is investing heavily here. And finally, the macro China plus one narrative. This isn't just a theme, it's a decade long structural shift. India is the primary alternative to China for specialty chemical manufacturing. Acutaas sits right in the sweet spot. We never do a one sided analysis on this channel, so let's look at what could go wrong. The number one risk, and I can't stress this enough, is the valuation. At 69 times earnings, this stock is pricing in a perfect execution scenario. Any quarter where growth disappoints, whether revenue misses or margins slip, and the stock could give back 20 to 30% quickly. High multiple stocks are brutal when they miss. Second, the high beta. If the broader Nifty or Sensex sees a correction, which is always possible given current global trade tensions and geopolitical risks, Acutaas will fall harder and faster than the market. This is not a defensive holding. Third, promoter holding at 32.7% is relatively low. This means the stock is more driven by institutional and retail sentiment rather than a concentrated founding family with skin in the game. Fourth, and this is a legitimate concern, the semiconductor and battery chemicals segments are still very early. These aren't just new products for Acutaas, they're genuinely complex, capital intensive areas where they're competing against global specialists. Execution risk here is real. That said, the lower risks, raw material and currency, are manageable, especially given the strong margin improvement trajectory we've already seen. So, putting it all together, what's our verdict on Acutaas Chemicals? Fundamentals: genuinely exceptional. Revenue compounding at 34%, profits at 42%, margins expanding rapidly, debt-free balance sheet, and multiple structural tailwinds from CDMO, battery chemicals, and semiconductors. Technically, the long-term chart is bullish. All major moving averages are supportive. The recent correction from 2,634 down to 2,131 rupees was healthy, and the stock has since recovered to 2,322 rupees. The catch: it is not cheap. At 69 times trailing earnings, you're paying a steep premium. This is not a value play. Our verdict: accumulate, but patiently. Ideally, we'd want to add positions in the 2000 to 2100 rupee zone, which represents a test of the 50-day moving average and gives a better risk reward setup. For investors with a 2 to 3 year time horizon, willing to stomach the volatility, this looks like a quality compounder. The Ankleshwar plant is just hitting its stride. Battery and semiconductor chemicals are early innings, and management has delivered on its commitments. For traders, the high beta means quick 10 to 15% moves are common in both directions. Play accordingly. Always remember, this is analysis and education, not financial advice. Do your own research, consult a registered advisor, and size your positions appropriately. And that's a wrap on our deep dive into Acutaas Chemicals, formerly Army Organics. now emerging as one of the most ambitious specialty chemical companies in India. To summarize, strong fundamental story, rich valuation, bullish long-term technicals with excellent long-term potential, but near-term volatility. If you enjoyed today's analysis, please hit that like button. It really helps the channel. Subscribe if you want more deep dive stock analyses like this one every week. And drop your thoughts, questions, or the stock you want analyzed next in the comments below. Remember, knowledge compounds just like good stocks do. Until next time, invest wisely.